What if the biggest financial shift of this decade isn't a crash, but a quiet exit? U.S. markets are sitting near historic highs. Indexes signal confidence. Officials keep repeating the word strong. Yet beneath that calm surface, something colder is happening. Global capital is reducing its exposure to the United States, not dramatically, not emotionally, but deliberately. No emergency meetings, no red banners, no public alarms, just money moving steadily away from the center. Silence isn't comfort. Silence is intent. If the United States is still the world's strongest economy, if the dollar still anchors global trade, if U.S. markets still dominate global benchmarks, then a simple question has to be answered honestly. Why has foreign capital growth shifted elsewhere over the last 18 months? Why have international institutions, reflected in IMF balance of payments data and BIS cross-border flow reporting, slowed their accumulation of U.S. treasuries while increasing exposure outside the dollar sphere? Capital does not react to speeches. It reacts to pressure. In 2024 and 2025, the Federal Reserve acknowledged the scale of the coming debt refinancing wall as trillions issued at near-zero rates mature into a higher-rate environment. The Congressional Budget Office confirmed net interest expense rising faster than defense spending. The FDIC, in post-bank stress assessments, documented unrealized losses still embedded in the system, contained by accounting treatment, not erased by growth. None of this triggered panic. That's the point. Every major financial transition starts like this. In late Rome, concurrency debasement wasn't announced as a collapse. It was sold as a necessity. Coins circulated. Trade continued. Yet real value drifted toward land, goods, and other stores of trust. In Weimar Germany, capital moved long before inflation became obvious to the public. The trap closed slowly, then all at once. Today's version looks cleaner. Instead of shaved silver, it's balance sheet expansion. Instead of emergency decrees, its policy is locked between inflation risk and debt service reality. The Federal Reserve's problem is structural, not cyclical. Tight policy strains the system. Loose policy weakens purchasing power. No option restores the old equilibrium. Global money sees the constraint. So it doesn't run, it reallocates. Shorter duration, less concentration, more exposure to energy, commodities, and regions with lower debt saturation. This isn't a verdict on America. It's math adjusting to risk. Here's the trap. Stability financed by borrowing feels like strength until capital decides it's too expensive to maintain. When that decision spreads, it doesn't show up first in crashes. It shows up in flows. Once you see that pattern, you can't unsee it. The surface still looks solid. Payroll numbers beat expectations. Corporate profits hold up. Market indexes absorb bad news and move on. From a distance, the system appears stable. But stability can be cosmetic. Stress doesn't always appear where people are trained to look. Inflation never truly left. It slowed, then stalled. Despite the most aggressive rate hiking cycle in 4 decades, prices for housing, insurance, food, and medical care remain structurally elevated. The Federal Reserve's preferred inflation gauge has stayed above target long enough to force an uncomfortable conclusion. Higher rates didn't restore purchasing power. They redistributed strain. Debt is where that pressure concentrates. U.S. federal debt has crossed levels that would have triggered emergency debates a decade ago. Now it barely registers as news. Cost is what matters. Treasury data over the past year shows interest expense rising faster than revenue, turning yesterday's low-rate assumptions into today's fiscal gravity. This isn't abstract. It limits policy. Housing exposes the contradiction most clearly. Employment remains strong on paper, yet affordability has collapsed to levels not seen since the mid-2000s. Mortgage rates reset monthly payments beyond the reach of median earners, while supply stays frozen by homeowners unwilling to surrender low-rate loans. Jobs exist. Homes don't move. Mobility stalls. Asset prices tell a different story than household balance sheets. Equities and real estate benefit from capital concentration, while wages lag behind cost structures shaped by global supply chains and leverage. Federal Reserve distributional data shows wealth gains skewed toward asset holders, while median households absorb higher costs without matching relief. This is where confidence and trust separate. Confidence shows up in markets. Trust lives in daily life. For the middle class, math no longer works. Raises trail inflation. Savings fail to preserve value after taxes and prices. Credit cards, student loans, and auto financing stop being bridges and start becoming permanent. Debt isn't a tool anymore. It's the environment. Yet nothing has snapped. That's what makes this moment dangerous. Systems don't break when panic sets in. They strain when adaptation becomes routine. As households lower expectations while institutions insist conditions are fine, erosion replaces shock. Capital recognizes that shift early. Not because it cares about sentiment, but because purchasing power defines returns. A dollar that earns interest but buys less over time is decaying. Large investors model that explicitly, comparing not just yields, but what those yields can claim 5 and 10 years out. This reframes the real question. It isn't whether America is collapsing. That misses the mechanism. The question capital is asking is colder. Is the United States still the best risk-adjusted place to store value, given rising debt costs, policy constraints, and shrinking room for error? When the answer turns uncertain, money doesn't protest. It prepares. That preparation doesn't look like fear. It looks like quiet reweighting, smaller commitments, and wider dispersion. The economy can appear resilient while its financial center becomes less attractive at the margin. That's the symptom most people miss. Surface strength doesn't prevent underlying pressure. It hides it long enough for capital to decide whether staying put still makes sense. This moment feels new, but it isn't. Capital rotation didn't begin with modern markets or central banking. It predates them. Long before tickers and terminals, wealth followed the same rule it follows now. It moves away from systems that become expensive to maintain and toward those that promise a stronger future claim on real goods. Empires don't collapse in a single event. They thin out. Financial strength erodes first, quietly, while political power and military reach still appear intact. Take the late Roman Republic. Rome didn't lose influence because trade stopped or authority collapsed. It lost ground because expansion outpaced productivity. Fiscal pressure mounted. Currency was altered to stretch resources without admitting constraint. For decades, daily life continued. Markets functioned. The damage lived beneath the surface, where trust in money weakened and private wealth drifted toward land, grain, and hard assets beyond the state's reach. The same sequence appeared in the Dutch Empire of the 17th century. Amsterdam rose as Europe's financial center through trade dominance and capital innovation. As returns from commerce narrowed, Finance replaced production as the engine of growth. Debt markets expanded. Speculation followed. Capital quietly found higher returns in emerging competitors with cheaper labor and growing output. The empire didn't disappear overnight. It faded as money chose elsewhere. Britain followed the same script in the early 20th century. Industrial leadership peaked. The pound still ruled global trade. London remained influential. But war costs and debt commitments forced Britain to defend status through borrowing. Capital didn't wait for defeat. It flowed toward the United States, where productivity growth and balance sheet capacity offered stronger long-term value. Across every case, the sequence stayed the same. Dominance peaked. Financial activity expanded faster than real output. Debt substituted for growth. Then capital began testing alternatives. This isn't hindsight storytelling. These shifts were visible at the time in balance sheets, trade flows, and lending patterns. People living through them argued the same way people argue now, that conditions were different, that systems had adapted, that decline was exaggerated. The pattern isn't moral or political, it's structural. Once maintaining leadership costs more than it returns, money doesn't fight the system. It exists gradually. That's what modern debates miss. A capital rotation isn't a reaction to failure. It's a response to saturation. Zoom out far enough, and the present stops looking exceptional. It starts looking familiar. The financial system is designed to keep you in the dark, but history provides the map to escape the trap. If this insight opened your eyes, hit the like button to help us break through the noise. Share this with someone who needs to see the patterns before the next collapse. And subscribe to master the mechanics of wealth that they don't want you to understand. Don't let your purchasing power disappear in silence. Drop a comment below, and let's discuss the truth the 1% ignores. Every financial decline follows a period of real success. That's what makes it difficult to recognize while it's unfolding. Before power shifts, there is always a long expansion phase. Output rises, trade widens, living standards improve. The dominant currency becomes trusted not by force, but by repetition. People accept it because it has worked for years, sometimes generations. Confidence hardens into assumption. That assumption is where the trouble begins. In every historical case, growth eventually slows, not because innovation ends, but because scale changes the math. The easiest gains are already captured. Productivity no longer compounds at the same pace. Systems then face a choice: accept slower growth or preserve the appearance of strength through finance. They almost always choose finance. Debt becomes the bridge. Expansion continues, not because output justifies it, but because borrowing makes it possible. Consumption is protected. Military reach is maintained. Political promises remain intact. On paper, nothing looks broken. The numbers can still look impressive. But the source of growth has changed. Instead of value being created, value is pulled forward from the future. Instead of productivity funding influence, balance sheets do the work. The economy tilts away from making things and toward managing claims on things. Finance grows faster than the real economy because it can. This shift isn't driven by incompetence. It's driven by incentives. Political systems reward present stability. Pain deferred feels like pain avoided. Leaders who slow growth deliberately rarely survive long enough to see the benefits. Leaders who borrow to smooth strain are praised for calm. Over time, Short-term management replaces long-term strength as the governing priority. Britain provides the clearest modern example. By the late 19th century, British industrial dominance had peaked. Other nations had learned the methods, adopted the machines, and competed on cost. Britain still controlled trade routes. The pound still anchored global settlement. London still financed the world. Manufacturing leadership, however, had slipped. Rather than shrink its role, Britain financed it. Empire costs didn't fall with productivity. They rose. Naval power, colonial administration, and global obligations demanded funding even as relative output slowed. Debt filled the gap productivity no longer could. The system stayed functional because finance carried the weight. For a time, it worked. Markets remained confident. The currency held. Daily life continued. Yet capital noticed the mismatch. Returns inside the empire narrowed. Returns abroad widened. Money flowed toward places where growth came from output, not leverage. That's the overlooked mechanism. Decline doesn't begin with collapse. It begins with substitution. Today's structure follows the same logic. The United States experienced decades of strong real growth, followed by rising confidence in the dollar as the world's reserve currency. Over time, financial activity expanded faster than productive capacity. Debt replaced margin. Asset appreciation replaced income growth as the stabilizing force. When growth depends on asset prices holding up, policy turns defensive. Interest rates can't rise too far without breaking something. Rates can't stay low without weakening purchasing power. The system operates inside a narrowing corridor where every choice carries cost. Success breeds complacency because it teaches the wrong lesson. It convinces systems that past solutions will always work, that confidence delays adjustment until adjustment becomes expensive. History doesn't punish ambition. It punishes denial. Once expansion is financed primarily by borrowing rather than output, capital begins testing alternatives. Not because collapse is guaranteed, but because better math may exist elsewhere. That testing phase can last years, sometimes decades. Most people living through it mistake it for normality. That's the setup phase. It's quiet, it's rational, and by the time it becomes obvious, the rotation is already underway. There is a name for what happens next. It's not capital flight. It's not collapse. It's capital rotation through relative decline. This mechanism appears when a dominant financial center no longer offers the best balance between stability, yield, and currency reliability. Capital doesn't require perfection. It requires confidence that tomorrow's claim will still hold real value. Stability comes first. Investors favor systems that absorb shocks without constant emergency measures. Over the past 18 months, the Federal Reserve has relied on liquidity facilities, balance sheet tools, and regulatory flexibility to contain stress. That response worked, but reliance itself sends a signal. Stability now depends on support, not organic strength. Yield follows. Not headline yield, but yield after inflation, taxes, and risk. U.S. Policy rates rose sharply, yet real returns stayed thin once persistent price pressure was considered. IMF and BIS data show global investors increasingly comparing U.S. returns, not only against Europe or Japan, but against energy exporters, commodity-linked economies, and regions with lower debt burdens and improving demographics. Then comes currency integrity. The dollar remains dominant, but dominance isn't immunity. Over the past year, BIS data has shown rising non-dollar trade settlement and bilateral currency arrangements. This doesn't dethrone the dollar. It reduces automatic dependence, a meaningful change when deficits expand and refinancing needs grow. When these three factors weaken at the margin, capital doesn't revolt. It reallocates. This is where the process is often misunderstood. There is no moment when everyone sells. Large pools of money operate under mandates, not emotion. Pension funds, sovereign funds, insurers, and reserve managers adjust weights slowly. A fraction here, a shorter maturity there, broader diversification over time. Marginal decisions compound. The first shift is almost always duration. Long-dated exposure loses appeal as debt issuance accelerates and policy paths narrow. Investors favor instruments that reset faster or exit cleaner. Treasury auctions can still clear while overall exposure quietly shortens. Next comes allocation. New capital flows less heavily toward the center. Existing capital isn't dumped, it ages out. Replacement capital spreads outward. Recent global fund flow data shows incremental inflows favoring infrastructure, energy supply chains, and non-US, socio-industrial capacity. None of this requires panic. Panic would disrupt the process. The critical detail is timing. Capital rotation happens before currencies break, before debt crises dominate headlines, before political instability becomes undeniable. Money is forward-looking by design. It prices future constraints long before it becomes visible to the public. History confirms the sequence. Roman elites shifted wealth into land while currency still circulated. British capital moved toward American industry while the pound remained global. Japanese investors diversified abroad years before deflation became a household reality. The trap is assuming strong institutions prevent this mechanism. They don't. Strong institutions delay recognition, making adjustment quieter and longer. The United States is not being abandoned. It is being repriced. As debt service absorbs more fiscal capacity, as policy choices narrow between inflation risk and financial stress, and as asset-based stability replaces income-based growth, global capital recalculates. Math doesn't need a crisis. It only needs a better alternative. That is relative decline, not failure or weakness, but a gradual loss of comparative advantage. Once that shift begins, reversal is slow. Not because decline is inevitable, but because restoring balance requires productivity strong enough to outrun debt, political will strong enough to accept short-term pain, and time long enough for trust to rebuild. Until then, rotation continues quietly. And by the time most people look for a dramatic signal, the decision has already been made, spread across thousands of small, rational moves that amount to far more than they appear. Follow the money, and the structure becomes visible. In the United States, the path is familiar. Household savings flow into financial institutions. Those institutions recycle capital into sovereign debt, mortgage securities, and large asset markets. The result is stability at the top of the system and inflation beneath it. Asset prices rise faster than incomes. Balance sheets look strong while purchasing power weakens. This isn't theory. Federal Reserve flow of funds data over the past year shows a growing share of savings channeled into government financing and asset-backed instruments, while business investment as a share of GDP struggles to regain pre-2020 momentum. Capital circulates inside the financial system more than it expands the productive base. That internal loop carries a cost. When capital defends existing structures, less remains to build new capacity. Productivity slows, wages lag, inflation becomes persistent because supply can't respond cleanly to demand. The economy keeps moving, but it feels heavier. Outside the U.S. core, a different math draws attention. Some regions offer higher real growth because they are still building, not maintaining. Infrastructure gaps remain. Energy supply is expanding. Industrial capacity is increasing rather than being preserved. IMF projections from the last 18 months show faster medium-term growth expectations in parts of Asia, Latin America, and energy-producing economies than in advanced, debt-saturated nations. Demographics amplify the difference. Younger populations require less capital to sustain pensions and healthcare systems. More of each dollar can go toward expansion instead of obligation. Over long horizons, that distinction compounds. Debt saturation completes the picture. When public and private balance sheets are already stretched, new capital carries higher risk. It must support past promises before generating new value. In lower debt systems, capital does more work. It builds instead of patches. Here, the metaphor holds. Capital behaves like water under pressure. It doesn't argue with ideology or negotiate with narratives. As pressure rises inside a system, money searches for relief points. Not dramatic exits, but small releases. BIS data over the past year shows rising cross-border lending outside traditional U.S.-centric channels. Trade financing increasingly bypasses dollar settlement when possible. Energy contracts settle in alternative currencies. Reserve managers diversify quietly, not to challenge dominance, but to reduce concentration risk. Inside the United States, pressure continues to build. Treasury issuance expands to cover deficits and refinancing needs. The Federal Reserve maintains facilities to manage liquidity stress. Banks hold assets whose value depends on rates eventually falling. This doesn't imply imminent failure. It implies dependence. That dependence is what capital prices. As more resources are required to keep the system stable, fewer remain for growth. Savers feel it through weaker returns. Workers feel it through stagnant purchasing power. Investors feel it through narrowing margins. So money doesn't rebel, it redistributes. Less flows into long-duration U.S. debt. More seeks exposure to energy supply, industrial rebuilding, and regions where growth comes from production rather than leverage. These moves don't make headlines. They don't need to. They only need to persist. This is the counterintuitive part. Asset markets can rise while capital rotates. The system can look healthy while pressure leaks through dozens of narrow channels. Stability at the center doesn't guarantee attraction at the margin. By the time the public notices strain, the flow has already reshaped the landscape. Water doesn't announce where it's going. It follows the slope. And that slope no longer points as sharply toward the U.S. financial center as it once did. Once you see the mechanism, history stops looking random. The first modern replay unfolded in Britain between 1900 and 1939. At the turn of the century, sterling still dominated global trade. London remained the world's financial clearinghouse. British institutions financed railways, ports, and governments across continents. On the surface, power looked intact. Beneath it, the math had shifted. Industrial leadership was moving to the United States and Germany, where output growth outpaced Britain's aging factories. Returns at home narrowed. To sustain global influence, Britain relied increasingly on borrowing. War didn't create the problem, it exposed it. World War I forced unprecedented debt issuance, binding Britain's financial system to obligations productivity could no longer cover. Capital noticed early, when even before the interwar years, British investors increased exposure to American industry, infrastructure, and equities. New York didn't replace London overnight. It absorbed capital gradually as confidence in future returns moved west. Sterling didn't collapse in a single moment. Its dominance thinned year by year as reserves diversified and trade settled elsewhere. By the end of World War II, the transition was complete. The war accelerated it, but the rotation had begun decades earlier. The second replay came in Japan after the late 1980s. Japan entered that period with extraordinary confidence. Decades of rapid growth had made its corporations global leaders. Real estate and equity prices soared. The Nikkei came to represent unstoppable momentum. Once again, success masked saturation. When the bubble peaked, the capital didn't flee in panic. It stalled. Domestic investment lost momentum as balance sheets absorbed losses that never fully cleared. Demographics shifted from advantage to burden. An aging population required rising fiscal support, financed through debt. Productivity gains slowed, even as financial intervention expanded. Japan avoided collapse through policy support, but the cost was lasting. Returns remained compressed for decades. The capital stayed parked, but unproductive. Global investors gradually shifted toward faster-growing regions, not because Japan failed, but because opportunity elsewhere exceeded stability at home. The lesson isn't that Britain fell or Japan collapsed. Both remained wealthy, functional societies. What changed was their position in the global capital hierarchy. Across both cases, the pattern aligns. Debt rose faster than output. Demographics aged, increasing fiscal drag. Financial assets became the system's stabilizer. Each new unit of capital produced less growth than the last. That is diminishing marginal return, the signal capital tracks most closely. When incentives reward borrowing over building, finance over production, and preservation over expansion, capital adapts. It doesn't challenge the system politically. It reallocates economically. This is where repetition is misunderstood. History doesn't repeat because events align perfectly. It repeats because incentives remain constant. Leaders protect stability. Institutions defend relevance. Policy postpones pain. Capital responds. Today's environment echoes those conditions. Debt levels sit at historic highs. Demographic pressure rises as populations age. Asset prices carry more of the system's stability than wages or productivity. Each new round of stimulus delivers less lasting growth than the last. None of this requires catastrophe. Britain didn't lose influence when belief vanished. Japan didn't stagnate because confidence collapsed overnight. The shift happened because better opportunities emerged elsewhere while internal constraints tightened. That is the repetition most people miss. The pattern doesn't repeat because history copies itself. It repeats because incentives do. And once incentives tilt against the center, the capital doesn't wait for permission to move. Bring the timeline forward to now, and the pattern reappears. Not in slogans, but in flows. Over the past 18 months, global ETF data tracked by major custodians and summarized in IMF and BIS monitoring reports shows a clear shift. New allocations are less concentrated in U.S.-centric equity and bond exposure than they were over the previous decade. This is happening while U.S. markets remain elevated, which is why the signal is easy to miss. The shift is marginal, not dramatic, and marginal moves are how large systems turn. New capital increasingly targets energy-rich regions with direct control over supply. Industrial rebuilding zones benefit from reshoring and geopolitical fragmentation. Commodity-linked economies attract flows because they sit closer to real inputs rather than financial claims. These aren't speculative trades. They are positioning decisions made by funds operating on 5, 10, and 20-year horizons. At the same time, U.S. exposure is being adjusted rather than abandoned. Duration shortens, concentration thins. The dollar remains dominant, but it's no longer treated as the only acceptable anchor. BIS settlement data shows non-dollar trade usage rising at the margins, reducing automatic dependence without challenging the core. That distinction matters. Compare this to earlier transitions. When Britain's dominance softened, capital didn't denounce London or revolt against sterling. It quietly increased exposure to American industry because returns looked stronger. When Japan's asset bubble peaked, investors didn't declare Japan finished. They found faster growth elsewhere and adjusted. Then, capital left the center quietly. Now, capital rebalances quietly. The behavior hasn't changed. Only the instruments have. What drives this isn't politics or sentiment. It's arithmetic. U.S. assets now carry higher embedded risk because they sit downstream from rising debt service, tighter policy constraints, and heavy reliance on asset stability. That doesn't make them poor assets. It makes them less dominant by default. This is where the narrative breaks down. Diversification away from U.S. concentration is framed as hostility or decline. In reality, it's institutional risk management. Pension funds, insurers, and sovereign managers are required to reduce single-system exposure once volatility and fiscal dependence cross defined thresholds. They aren't voting against America. They're hedging against constraint. The United States still attracts capital. It just no longer absorbs it automatically. New money asks harder questions. What protects future purchasing power? What preserves real returns after inflation and refinancing risk? And whether growth comes from leverage or production. When the answers are mixed, capital spreads out. This is transition in real time. No crisis, no headlines, no public reckoning, just gradual repositioning while markets still look strong. People expect exits to look emotional. This one looks professional. By the time it becomes obvious, the rebalancing will already be reflected in currencies, yields, and long-term growth, long after the decisions that shaped it were made. That's how capital rotation returns to the present. Quietly, methodically, and without asking permission. The cost of capital rotation doesn't show up first in markets. It shows up in people. Wage earners feel it immediately. Over the last 18 months, nominal wages in the United States have risen, but not enough to reclaim lost ground. Federal Reserve data shows real wage growth struggling to outpace core inflation once housing, insurance, and healthcare are fully counted. Paychecks arrive on time. Purchasing power doesn't. Savers experience it differently, but just as sharply. Households holding long-term fixed assets, bonds, pensions, and stability-focused savings, watch value erode quietly. Even with higher interest rates, returns often fail to clear inflation after taxes. What was once considered safe no longer protects the future. It only slows loss. Households dependent on asset appreciation face a different squeeze. For years, Rising home prices and equity markets masked structural weakness. Asset growth substituted for income growth. That bargain is now strained. Housing affordability has collapsed while prices remain elevated, locking owners in place and shutting new buyers out. The wealth effect still exists, but it no longer circulates. It concentrates. This is where the system becomes emotionally unstable even if it remains financially intact. Persistent inflation reshapes daily behavior. People trade quality for price, delay medical care, and accept longer commutes. These aren't lifestyle choices. They're adaptations. Bureau of Labor Statistics. Data confirms it. Essentials take a larger share of income, leaving less room for advancement. Borrowing costs compound the pressure. Auto loans, credit cards, and small business financing now carry rates that would have seemed punitive a decade ago. The Federal Reserve didn't intend to trap households in debt, but the outcome is clear. Credit stops being a bridge and becomes permanent support. Upward mobility slows first. Entry-level housing disappears. Education costs rise faster than wages. Starting families becomes a financial calculation instead of a life decision. None of this triggers crisis headlines. It accumulates. Here's the emotional truth policy debates often ignore. Systems adjust slowly, but people experience them daily. When capital rotates away from a system, it doesn't announce itself to workers or explain itself to savers. It shows up as tighter conditions, narrower margins, and fewer second chances. Stability remains. Opportunity thins. Trust erodes before confidence collapses. People still work. Markets still function. But belief in progress weakens, and that belief holds social systems together during strain. FDIC household vulnerability assessments highlight rising delinquency risk at the margins. Not systemic, but spreading. Treasury data shows household debt servicing costs climbing as a share of income even without recession. These are early signals, not alarms. Capital has already adjusted. People are still catching up. That asymmetry defines transition periods. Institutions move first. Households adapt later. By the time pressure feels unbearable, the underlying shift is already mature. Nothing here requires catastrophe. Britain didn't lose influence when workers first felt squeezed. Japan didn't stagnate when savings momentum slowed. The consequences appeared gradually, then persisted. When systems change direction, no single moment marks the turn. There's only a growing sense that effort yields less, risk carries more weight, and stability demands constant compromise. Markets may price the future early. People live it one bill, one loan, one decision at a time. And once that daily pressure becomes normal, reversing it becomes far harder than ignoring it ever was. Every system reaches a threshold where adjustment stops being optional. That threshold appears when debt servicing begins competing directly with national priorities, not in theory, but in budgets. Over the past year, U.S. Treasury data shows net interest expense accelerating faster than defense, infrastructure, or education spending. The Congressional Budget Office now projects interest costs consuming a growing share of federal revenue well into the next decade, even under optimistic growth assumptions. This is where flexibility ends. Once servicing past debt absorbs future capacity, policy stops being about choice and becomes about containment. Governments no longer debate what to invest in. They debate what they can afford not to cut. The system still functions, but inside narrowing walls. From there, Options collapse into a small set of imperfect tools. One path is inflation, not runaway inflation, but persistent price pressure that reduces the real value of obligations over time. This quietly transfers cost from the state to households. Savers pay. Wage earners lag. Debt looks manageable only because money buys less. Another path is financial repression. Capital controls need not be explicit. They appear as regulatory pressure, forced demand for sovereign debt, or incentives that trap savings inside the system. The BIS has documented versions of this repeatedly across advanced economies facing high debt loads. It stabilizes funding. It suppresses returns. The final path is continued borrowing. Roll the debt. Extend maturities. Assume growth eventually outruns obligations. This works until it doesn't. As issuance expands, should markets demand higher compensation, servicing costs rise again. The loop tightens. None of these restore the old balance. They manage decline. Reversal is simple to describe and difficult to execute. Lower debt, higher productivity, political sacrifice. Once rotation begins, those conditions become rare. Reducing debt requires surplus or default. Surpluses demand spending cuts or tax increases large enough to slow growth. Default destroys trust immediately. Systems avoid both. Raising productivity takes time, capital, and reform. It requires investment in education, infrastructure, and innovation without relying on leverage. Those payoffs arrive after election cycles end. Political sacrifice is the hardest. It means telling voters expectations must fall before strength can rise. History shows how rarely that message survives. Britain delayed adjustment until war forced it. Japan never cleared balance sheets fast enough to reset growth. Rome debased rather than restructure. In every case, delay felt safer than adjustment. That delay locks the rotation in place. Once global capital senses a system cannot reduce debt without destabilizing itself, assumptions change permanently. Money stops expecting reform. It expects management, and management doesn't reverse decline. It stretches it. This is the real point of no return. Not collapse or crisis, but the moment restoring dominance becomes politically and mathematically unrealistic. From there, the system can remain rich, powerful, and influential. It simply won't be singular. Capital won't concentrate as before. Growth won't feel automatic. Stability will require constant intervention. And that's why this phase is misunderstood. People wait for dramatic signals, a crisis vote, a currency shock, a public admission. Those moments come later, if they come at all. The real turn happens quietly, when debt stops being a tool and becomes a constraint. When every solution creates a new problem. When capital decides the risk is no longer failure, but stagnation. Once that decision spreads, reversal isn't about will. It's about time, trust, and sacrifice. And by the time those conditions align, the rotation has already reshaped the world around the system that refused to believe it could ever lose its center. Here is where most interpretations go wrong. People hear everything up to this point and assume it leads to collapse. They wait for a single event, a crash, a crisis, a visible break. History rarely works that way. Capital rotation is not failure. It's an adaptation under constraint. Money moves early because it must. It doesn't wait for confirmation from headlines, elections, or official language. When debt rises faster than productivity, when policy options narrow, when future purchasing power becomes uncertain, capital adjusts while adjustment is still possible. That isn't pessimism, it's survival logic. This is why the process feels underwhelming to those expecting drama. Institutions don't vanish. Markets keep operating. Governments remain functional. What changes is positioning, not existence. So the center holds, but it no longer pulls everything toward it by default. History becomes clearer once you stop looking for endings and start looking for transitions. Rome didn't disappear when wealth shifted into land and goods. Britain didn't collapse when sterling lost automatic dominance. Japan didn't implode when growth flattened and returns compressed. Each system stabilized. Each endured. What changed was their role in the global hierarchy. That distinction matters. This isn't a prediction. It's a pattern. Patterns don't provide timelines or guarantees. They explain behavior long before public agreement forms. Once the pattern is visible, markets stop feeling contradictory. Asset prices can remain elevated while concentration weakens. Capital can rebalance away from the center while indexes rise. These aren't opposing signals. They reflect repricing, not abandonment. Policy actions read differently as well. Rate changes, liquidity facilities, and regulatory flexibility aren't signs of chaos. They're containment strategies used when debt service, demographics, and productivity limits restrict clean solutions. Policymakers aren't choosing ideal outcomes. They're managing trade-offs inside narrow boundaries. Headlines lose their emotional pull in this framework. Strong employment doesn't undo rising interest costs. Market resilience doesn't erase structural strain. Stability today doesn't guarantee strength later. Understanding capital movement changes how fear operates. People panic when they're surprised. They stay steady when they recognize direction early. Those who understand how money responds to constraint don't wait for crisis signals. They watch incentives, flows, and pressure points. They focus on where value is being built, not just where prices are quoted. This isn't optimism or pessimism, it's situational awareness. The system isn't breaking, it's reshaping itself. And reshaping always feels unsettling to those still relying on assumptions formed during a different phase of growth. History never promised permanence. It rewarded those who recognized transition before adjustment became unavoidable. That is the insight that matters. Understanding capital rotation doesn't create fear. It creates preparation. And those who are prepared don't panic later, because they already understand what they're seeing, while others are still debating whether anything has changed at all. So here is where everything converges. What you've been watching isn't a forecast of collapse. It's an explanation of movement. Systems rarely end when people expect them to. They change shape instead. Power shifts without announcement. Influence diffuses, advantage relocates. This is the part history never dramatizes in real time. Rome didn't hear a warning bell. Britain didn't receive a final notice. Japan didn't wake up one morning to find its era over. Each transition unfolded quietly, measured not in headlines but in balance sheets, trade routes, and capital decisions made far from public debate. The present moment fits that pattern uncomfortably well. Markets can remain strong. Institutions can remain intact. Daily life can continue. None of that contradicts transition. In fact, it often conceals it. Capital doesn't wait for visible decline. It reacts to constraint, to narrowing options and future purchasing power at risk. That's why this matters. Once you understand how capital moves, you stop mistaking noise for signal. You stop waiting for permission to notice change. You recognize that the most important shifts happen long before they become undeniable. This isn't about fear, it's about orientation. People who don't understand these patterns feel blindsided when conditions tighten. People who do understand them feel prepared, not because they know what will happen next, but because they recognize the phase they're living in. History never shouts its intentions. It leaves traces. Those traces are written in capital flows. This is the collapse pattern, not the end, but the transition. History doesn't warn loudly. It whispers through capital movement. And those who learn to read those signals see the future forming long before it arrives.